The candle range theory is a trading concept that, if learned properly, can skyrocket your results. After this video, you will have the necessary skills to identify and implement this concept into your trading plan. So let's jump right into the details. As the name suggests, before going into the charts, we need to understand the theory of this concept. Each candle represented on a chart represents a visible price range or movement, or explained simpler, a candle you spot on the macro high time frame will represent and print a range of price movements inside the micro lower time frame. The anatomy of a candle says that every candle has an open price, a close price, a high price, and a low price. So keep in mind that this is only one candle as we see it, but whatever the time frame this candle would be, if we zoom into a much lower time frame, we see the exact same price but under a more detailed movement. This detailed movement is called a low time frame range inside of the high time frame candle. And keep in mind, CRH means candle range high, and CRL means candle range low. We are soon going to talk about their importance. Now, what is also very important to know is the power of three concept, a concept that I did not specifically touch on my channel, but we are shortly going to cover what it is, how it works, and why it's an important implementation for the CRT trading model. The power of three is a concept that shows the flow of market movements. The market has three flow movements. Accumulation. The accumulation is a ranging price action that shows a sideways market. This is often the reason of market makers and also retail trader placing their pending orders on small volumes. This is what you probably heard from other traders. Some don't understand, so let's simplify it as much as possible. The accumulation is just a period of preparation for an upcoming big move. The other market flow movement is the manipulation. The manipulation is the first breakout from the accumulation, but the manipulation, as the name says, is often a false move to trap traders. Some would ask, why would traders get trapped? Well, because trading is a constant competition, and for winners to exist, we also need losing traders. And that is what the manipulation does to traders that can't identify the moves properly. And the last market flow movement is the distribution. The distribution is the opposite move of the manipulation. So if the manipulation was to the upside, you will likely observe on the charts that price distributes to the downside. All of these three types of market flow are also often met and applied on sessions trading strategies. For example, you might see that the Asian session is moving the market sideways into an accumulation. Then the London session breaks that accumulation either to the upside or to the downside into a manipulation. The manipulation from the London session prepares the market for the New York session to take the price in the opposite way of the London session. I'm sure you have seen this pattern repeat many times. However, keep in mind this does not always happen. Sometimes we might even see the Asian session distributing the market, then London session accumulating on a sideways action. However, this is rarely met because usually London is a high-volume trading session. The London trading session usually makes or breaks a trend instead of moving sideways. But if this rare pattern happens, it's probably a preparation stage for the New York session to initiate a manipulation move, and for the flow cycle to repeat. There are two cases. We start explaining the bullish case first. The candle range theory model usually refers to a multiple candle sequence on a high time frame. And let's explain how this works. The first high time frame candle forms a low time frame trading range between its high and low. The next high time frame candle takes out the liquidity of the first high time frame candle with a wick. And the final high time frame candle from the sequence breaks out to the opposite direction from the first break. The first break being a sweep of liquidity from the candle range low. So we still have a similar concept to the power of three. It also involves the accumulation, manipulation, and distribution of price. I represented the CRT with three candles. However, keep in mind that it's not just a three-candle sequence, but most of the times it's a sequence of multiple candles. The important part that is the same pattern repeats itself. As an example, look at this, where we got multiple candles, considering the first candle as the CRT model candle, and the next couple of candles do not break the lows or highs of the CRT candle. It's not a problem, or it doesn't invalidate the analysis, because we can see that the manipulation break towards the candle range low happened a couple candles later, and also after the manipulation, the distribution or accumulation doesn't have to move significantly towards the opposite way of the manipulation right away. Most of the times we would see that it slowly goes towards there across multiple candles. And the same applies for the opposite break. So if we got the CRT model candle, and the price first breaks the candle range high by a manipulation, we would look towards sell-sided trades towards the candle range low. The CRT model and pattern can appear many times, and sometimes it can lead to false signals. So in order to avoid getting trapped, we need to know and understand the high probability CRT models. The best way to increase the quality of the CRT trading model is to look for the CRT main candle to be near, or at a point of interest or key level. As we know these points of interest or key levels, they're basically the same, just so you know. These levels are concepts like order blocks, supply and demand areas, fair value gaps, imbalances, usually levels where the market has a high chance of a volatile reaction, and we can get even a higher quality CRT model if the time where this pattern forms is on the following hours. Also keep in mind this is based on the New York time zone. The time is not a necessity, but it improves the probability of the trade. The more rules are aligned, the higher the quality and probability of the setup should be. So let's go into the charts and learn how the candle range theory works. Usually we start the analysis from a higher time frame. In this case, we are first using the 4-hour chart. Initially, we got a push to the downside and a pullback to the upside. This pullback breaks an internal lower high and forms a new internal higher high. And because the previous internal trend was a downtrend, and we turned the microstructure into an uptrend, we got an internal change of character to the bullish side, which respects the following uptrend structure. Price structure of constant higher highs and higher lows. Here, for example, we see a liquidity sweep, a break of the swing lows. But it failed to continue the potential downtrend, and it rejected instantly to the upside. I always tell be careful to avoid getting trapped. Anyway, later we got a continuation of the high time frame macro uptrend. So now we also got a bullish change of character. So we got both internally and externally aligned to the same direction. And from just simply looking at the price action, we can see how price behaved. This helps in understanding the higher probability direction that the market might move. If we are able to analyze simple market structure, for example, we got here another push to the upside and a pullback to the downside, we need to know swing level formations and their application on market structure. If we see a higher low formation, well, we know it's an uptrend structure. And on uptrend structure, we look for buy-long positions. Because why trade against the trend? Why complicate ourselves? And we also see the final upside push, which comes with a new higher high formation and a bullish break of structure. So now, coming into the recent price action, we have analyzed and identified that the market follows an uptrend. The last candle we see is at 5 a.m., which is a time we mentioned it's important, and being on the 4-hour time frame, the next candle is the 9 a.m. candle. A very aggressive candle, which indicates that some big positions have been opened, with much higher volume than we did see recently. A candle that takes liquidity from this support level that is more easily seen on lower time frames. This aggressive movement scares traders into thinking that the market has entered a downtrend, and they place sell short positions looking to take price down into new lows and new lower highs, basically expecting a formation of the downtrend structure. The problem of these traders is that they don't have patience and rush on emotions. Let's see how a patient trader acts, considering we wait for a couple more candles. Smart traders have seen the slow pace and ranging market of the movement at the highest price we can see. Well, this is nothing but just an accumulation. An accumulation, as we said, is a price range moving sideways that prepares a large movement. And what often comes after the accumulation? A manipulation. What if the large downside candle is the manipulation? And if we consider the power of 3 implemented with the candle range theory, and using the time that this large candle has printed, we draw its liquidity, which is the candle range low, which has been broken down first, and the CRT main candle also has the candle range high level. This large movement has caused this imbalance. Notice this emptiness on the chart, an inefficiency that will eventually get filled. And because the manipulation was first done towards the breaking of the candle range low, we are aiming for price to rebalance itself and distribute towards the candle range high. That means that we are looking for buy-long setups. So let's zoom into a lower time frame, the 30-minute for example. If we check the recent price action, we can see that from this candle, the trend has initiated a trend reversal towards the upside Before that candle, the price was in constant downtrend on this time frame. After the reversal candle, the market started forming higher highs and higher lows internally. So if we consider that candle as a demand zone, with the fact that the price is quickly approaching the demand, we can look for buy long orders at the top of the demand. The stop loss can be placed below the demand, or even safer, below the last swing low on this time frame. And in this case, we are looking for a more swing type of trade. And for the take profit, we can look towards the candle range high. But in my honest opinion, the risk to reward is way too high. I think 1 to 4 risk to reward is great enough, even if the setup might give a full 1 to 8 or higher. Don't be too greedy. And we basically expect a type of uptrend structure formation. The main point is taking price higher after manipulating the candle range low. So let's play the price. Trade closed in, take profit. I tell you the CRT model can be slightly harder because you trade with the higher main trend, but in the short term, we trade against the trend, basically timing the pullbacks. That's the only hard part of this strategy. The rest of the strategy is mechanical and less subjective. Essentially, just repeated patterns you can see over and over again if you train your eyes to practice enough. On another chart backtest. Initially in this market, we had a sideways ranging market consolidating above and consolidating below. The consolidation broke to the upside, forming a new higher high and an upcoming pullback as a higher low, with a break of the new highs forming higher highs. The first high being broken and leaving the consolidation is a bullish internal change of character, because that is the price level that has switched this market into an uptrend internally on the microstructure. We have higher lows, just like we said, and a formation of a bullish break of structure after breaking the second internal high, just to shortly after form constant low time frame higher highs and constant higher lows, printing an internal uptrend formation. But what we care the most is the macro structure. We can mark the macro or external structure by targeting the swing points directly. For example, we start from the higher low, formed an external higher high, and formed another external higher low. And finally, a push to the upside, which creates new macro highs. A pullback to the downside, pullback ending higher than the previous one, and a last impulse to the upside. Impulse which sets the last external bullish break of structure that we can see on this chart. Now that we analyze this market, we move to the most recent price action. And we know that the market is following an uptrend, and the market did not have any significant liquidity sweeps or traps. It moved pretty clean towards the upside. If the trend keeps its continuation, we would expect a pullback to the downside, a push back to the upside, and this kind of uptrend structure to be formed. Now if we look, this large candle has printed at 5 a.m., a time that I mentioned before to remember because it comes with large volumes, usually being the manipulation movement by implement the power of 3 concept, and with the implementation of the candle range theory, we draw the liquidity targets of the candle, which are the candle range high and the candle range low. If we look closely, the candle range low got broken down by the next candle, a candle that instantly reversed to the upside after breaking the last candle's low. And as in the last example, the large movements leave an inefficiency in price action, the chart being basically inefficient at these levels. And as we know, inefficiencies get filled. And in this example, that means that the price will eventually look to push to the upside, and it works as a great confluence knowing we got an untapped candle range high that smart money might look to liquidate after already liquidating the candle range low. So now let's zoom in to see the price action inside the zone better, and look to refine setups into the 15-minute time frame. If we look on the last candle before the last impulse, marking it as a demand zone, and placing a buy long order at the demand zone, stop loss below the demand, or below the last swing lows, which is the level I prefer in this case because the demand is very small and might not be a high-quality demand to support a small stop loss. So in this case, we are also looking to target a swing type of trade that will last slightly more. If we place the take profit right above the candle range high, we get a pretty small risk to reward. That's because of the wide stop loss. But no problem as we can look to target the swing highs, expecting a bullish break of structure as a continuation of the uptrend, with a great 1 to 3 risk to reward ratio. So now let's play the price. Yes, that's it. And it even went higher, being capable of a higher risk to reward ratio. But we can't know the future to that extent. 1 to 3 is more than enough. And also there were many candles involved in this position. If we look closely, we can probably find even more trading setups. And yes, there is one, a fair value gap that was formed shortly after the demand. This is the beauty of understanding market structure. There are many setups available, not only one, but this comes with a better trained eye on the charts. Now, the most frequent problem I see traders having on the CRT model is not being able to identify the CRT main candle. One way to eliminate that problem is to respect the times that I mentioned before, and wait for that time that prints an aggressive candle on the 4-hour chart. In this example, we are going straight to the point. So if we move the mouse to this candle, we see it's at 1 a.m., an important time. So what we do is mark the candle range high and the candle range low. And don't forget to analyze the market of key levels and points of interest, because that is why market analysis can become helpful using the candle range theory model. In this chart, the most recent point of interest is a supply zone, right? So a supply zone is the last candle before the impulse. And we are able to see that the CRT main candle has filled the supply zone. That means that the market has a bearish outlook, and the next candle wicks up the last candle's high, taking its liquidity, and instantly reversing to the downside to break the candle range lows after first breaking the candle range high. One way to use this as a trading opportunity is to zoom in, let's say into the 15-minute time frame, because the supply is a small zone relative to the range, and after the price has done its liquidity sweeps and reverse back down. We look for setup models after the downtrend formation has started. A simple and effective setup in this case would have been placing a sell short position after the liquidity sweeps to the upside, which candle pushes aggressively to the downside holding a bearish momentum, with the stop loss around above the high time frame supply zone, and the take profit below the candle range low because the price first manipulated and broken up the candle range high. We simply target the candle range low afterwards. As a recap to make sure you all understand, the CRT main candle can be identified in many time frames. However, the one I found to be the simpler to identify and trade is the CRT candle on the 4-hour chart. We have the CRT main candle that prints at the mentioned hours, time when usually an aggressive candle prints out. That is our CRT main candle. We mark its candle range high and its candle range low, and wait for the next coming candles to first break one side of the range, either the high or the low, which in this case it was the low being first broken down. Then we zoom in from the 4-hour time frame into the 15-minute time frame. This can also be done on the 30-minute time frame. However, as I said, I found the combination of 4-hour time frame into the 15-minute time frame. That doesn't mean that it's the best, but that's what worked better for me. You can feel free to try many combinations and maybe tell us in the comments how you structure your trading plan. So anyways, switching into the 15-minute, considering we are looking for the market to move towards the candle range highs, we look for entry models that support an uptrend scenario. This price action contains both the 4-hour chart based on the CRT candle, the 4-hour zone is drawn on the purple zone, and the 15-minute chart is drawn inside the yellow zone. We also see here the first break on the candle range low. So as we said, considering we are looking to target candle range highs being the next liquidated levels, we look for entry setups towards the uptrend side, and by zooming in the 15-minute time frame, we can see a bullish fair value gap. Now we have two positional setups, placing a buy-long order at the top of the fair value gap with the stop loss below fair value gap and take profit above the candle range high. By taking this setup, you consider that the price will not go below the fair value gap, which is more risky. But I personally found better setups using this approach. And the second positional approach is the same for entry, placed on the top of the fair value gap, but this time the stop loss going below the candle range low. When taking this, you consider that the price will not break candle range low before first breaking candle range high. This type of setup will probably win more trades because of the lower risk to reward ratio. I usually do this trade only when there is more data from the higher time frame. For example, if there's a key level to take profit from, I will place the take profit around there, and this increases the risk to reward ratio. And that's all for this video. This strategy implemented correctly is very powerful, but you need to master price action, market structure, and liquidity to use the CRT model most efficiently. To master all the key concepts of trading, and if you liked the video, give us feedback in the comments and give us ideas on what topic should we cover next. Thank you.